Morning, Market Chameleons. Happy Tuesday morning. Dima, how you doing?
Good morning, Will. How are you?
Awesome. Wait to see what's going on in the pre-market with these markets moving. Let me start with the disclaimer, though. What do you think?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, contact your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent. Also, a couple housekeeping notes. We have a webinar today. Well, actually, it's mostly you, Dima. You have a webinar today with Interactive Brokers at 12. So I'll put that link into the chat so anyone who hasn't registered and wants to register that can do that. And
we'll talk about vertical spreads, talk about probabilities, estimated values. So I'm going to try to go over some of the things that you would see in a vertical spread screener. So that's what we'll do. We did a little bit yesterday, but that's what are we like scheduled for an hour?
That's what it says.
Right. So we'll go over and do some screens, talk about vertical spreads. That's going to be today at 12 o'clock. But with that, I think today what we'll do is we'll go over what's moving in the pre-market hours, and then I'll take a look at maybe SPY or IWM. I think you did have some questions. Did you have some questions yesterday that we left outstanding?
Well, one was I think the mayor from Naples was asking about SNDL, but we looked at that and it looked like a penny stock, so not really much to do there.
Yeah, I'm not going to go into talk too much about the penny stocks.
It is amazing. We looked at these ARK investment in Kathy Woods, I don't know, 2-3 months ago. Yeah. Some of those stocks she owns have gotten their shirts ripped off. I mean, I was looking at Palantir this morning, it's down to like $16.
Yeah, a lot of these high-tech stocks. And you were talking about, Will, the headline, and we've been kind of talking about it here and there about inflation and how we're seeing it everywhere we look. It's not, sometimes you just read about inflation, but you don't feel it as much as you do now. And more companies are reporting it. It's becoming a reality. And I think that what's happening is that the Fed kind of painted itself into a corner, right? If they say, well, we're seeing inflation and we're going to have to do something about it, that's going to spook the market. But when they're trying to calm things down and say, well, we're not really concerned about this inflation, what their argument is, well, we've been expecting this because it's transitory. In other words, well, everybody was at home during the COVID, and now that the economy is opening up, people are rushing out to spend money and do things they were not able to do. So we're seeing a push in prices, and they say that over time that will normalize back to levels pre-COVID. That's their argument right now. But if you're out there, and you're seeing prices going up and not only are you seeing it, more and more people are talking about it, it becomes a reality to you, right? And feeds upon itself. And what could be worse is that people feel that they can't trust what the Fed is saying, that even adds fuel to the fire, right? Well, it's like pouring more gas onto the fire.
Well, it's funny because I briefly mentioned Druckenmiller had a piece today. I think it was in the Times, in the op-ed, but he was also on CNBC for about a half an hour. And Robert from Chicago mentioned it was a must watch for chameleons. I do recommend everyone watch it, but it's a little dark, so you got to be careful. You don't want to bury your head in the sand, but he may not be absolutely right either. But certainly, we talked about it a lot yesterday, but I mean, today in the paper, used car prices are at an all-time high, up 16% this year.
Yeah.
Price of chicken breasts have doubled since the start of the year. We've talked about our own experience at lumber, going to Lowe's. I mean, it's very, very interesting. Corn prices are up 50% this year.
And I've been kind of reading and taking a look at, well, how do you protect yourself against inflation? What tended to do well during periods of inflation. And here's the real issue here, that if you're buying stocks, even the stock market, inflation, the way we're starting to see it, is not necessarily good for stocks. It's not even a hedge for stocks, because companies need stability, right? They need to know how much does something cost them to produce, either a good or a service, and how much can they expect to sell that good or service in the future. Without that stability, it becomes very hard to conduct business. You cannot make plans or investments when you have instability in the marketplace and prices are moving around. It's hard. And the labor markets as well, are going to be moving around. Like we're in a situation where we still have high unemployment, and we're paying people, to sit on unemployment, but we also have a tight labor market where, there aren't enough drivers out there to make deliveries. There aren't enough, workers to hire. There aren't enough. So you have this really weird situation right now where we still have, we're not at full employment, so the Fed's keeping the interest rates low, pumping money out, but we also have a tight labor market as well. We just don't have enough people out there, to, I mean, we see delays right everywhere, just in manufacturing and delivery in lots of places. And when I looked at, even stocks, here's the other issue, before we go into the show. Sometimes you invest in a stock and you think you're investing one way, but you don't know exactly what all these companies have under the hood. They report earnings, so they give you some information, but nobody really knows what they have under the hood until something happens and there's a shakeout. And I'll give you an example, like Orange County. Nobody thought, why would Orange County, what happened to them? Well, they were invested in like some kind of credit default swaps or something like that. To goose their returns.
Yeah, well, to try to pay for retirement packages, right? Everyone's panicked about the, outstanding debt that they have to pay, everyone who's worked within the county system in these.
And they're doing things, under the hood. They're not even, and it's not transparent. And a lot of companies are like that. Now, when we were in 2008, for example, Will and I were seeing that, hey, there's a lot of danger in these mortgage company, real estate companies. So we were looking
did we get that right and wrong at the same time?
We were very early, so it was painful on the way up. But at the same time, I'll give you an example. I was like, well, you know what? I'm going to buy, and here was my thinking. I'm going to buy E-Trade because at least I feel E-Trade is a discount broker. And my thought process, well, they collect tolls. Basically, they're facilitating trades, clearing trades for customers, and they're collecting tolls. So it could go up, it could go down, but at least I know that all they're doing is just collecting fees for doing a process. So to my surprise, all of a sudden I'm seeing, E-Trade one day just collapsing. They're down. I think they went down like 90%. Oh, well, what's going on? How, people didn't stop trading. All of a sudden they're like, oh, well, we were buying mortgage-backed securities. So they were buying mortgages to goose up their returns. I had no idea, nobody talked about that before, but they were just doing that to goose up their earnings. And that's the issue with like these stocks right now. It's fuzzy what else is going on. Even if you look at their financial statements, it's not exactly clear everything, all their contracts. They could have long-term contracts in there with some terms that could be very detrimental to their business. So it's very difficult, to get into some stock. And especially when we see either interest rates moving or volatility in like the fiat currencies, there's going to be shakeouts, right? And that will tend to pull down companies and other assets along with it. So other than that, if we think, and this is what I'm going to get to my point, if we think that there is going to be inflation fears and it's going to cause volatility, maybe getting into volatility while it's relatively low could be a better do than just trying to hedge buying stocks. What do you think, Will?
I think it's worth looking at. That's for sure.
We'll take a look at that. If prices are moving around, stocks are going to be moving around. And even, what do we say? Well, even good stocks will get pulled down with everybody else because everything is getting forced either to get sold and everything else gets pulled down with it. So we'll take a look at SPY IWM today. We'll look at its volatility. So let's start with the pre-market report, but that's what I was getting at when we were talking about the inflation fears. So this is the pre-market report. Stocks moving into pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Here I'm seeing 42 on the percentage made our percentage gainers list, 435 on the percentage decliners list. So from that perspective, very bearish bias at the open. I'm going to take a look at the higher market cap stocks. So I'm using this filter market cap, 20 billion market cap or higher. So we'll see what's going on in the higher market cap stocks. And let me see why. Hold on, let me refresh my screen. Well, I don't know why my internet's been. Have you been experiencing like slowness with your internet in general?
Yeah, you got to pay a higher toll, dude. Prices are up.
Yeah.
No, but I mean, it is interesting. You're in the city, and I would have thought your internet would have been maybe better because more people were going back to work. But the amount of people on the networks has been huge. I mean, in your house, I'm sure everyone in your house right now are online.
Zoom, right? Everything is like going through Zoom or those types of video meetings. So here, $20 billion market cap or higher. We got one today, made the percentage gainers list, 158 on a percentage decliners list. So you could see here, from that perspective, very bearish bias at the opening. If there are no questions on here, there was a question. I think you said something about a split, actually. Will.
Oh yeah, it was. I think that was maybe Chuck who asked that, but I think CP was the stock that was splitting.
Okay.
That was from a couple days ago. He
Let me get to that. Yeah, since that question came up, and I did say we'll talk about it. Let's just take a look at that real quick, and then I'm going to come back to IWM and SPY. So here's CP, Canadian Pacific Railway, and I guess that what they announced that they're going to split. Let me just take a look real quick. So here's our split. So here's CP, May 14th, 5-for-1 stock split. Okay, so that's what's going to happen. And I guess the question is what will happen to the stock and
how does it affect the stock? How does it affect the options?
Okay, so whenever you have a corporate action like that, so here's CP, obviously $400 almost. And the question is, how will it affect the stock? Well, basically, for every one share you have, you're going to have 5 shares. So the price will be adjusted to reflect that. So it's not like you had one share at $3.98. Now you have 5 shares and the price is still $3.98 because everybody would be buying it ahead of that. That price the next day will get adjusted, so by 5, right? So divided by 5. So you'll have basically more shares, but the value of your investment should remain the same. Of course, the stock can move around, but it's not like a windfall of 500%. So
it's the same market cap. There used to be a theory that, that a lower price stock would maybe attract more investors. That was a theory.
The theory was, if the lower the price of the stock, the more investors, because, $398 stock, less people would be willing to buy it just because the price is so high. That was the theory. So the lower the price, more people would be willing. But the market cap should remain the same. Everything gets adjusted. You just have more shares out there, and the price per share is adjusted for.
Yeah, and now with fractional shares, you know, people can spend $1 on IBM if they want. You know, it doesn't really matter.
Right. So that's how the stock works. What about the options? Well, the options, the options clearing corporation, they clear all options, right? So they're the clearing agency for all the options. They'll give you instructions what will happen, and usually in a split, they're going to adjust the strike prices according to the split, right? And the deliverable, they're going to adjust according to the split. So if you need to see what's going on, you go to the OCC. So this is the Options Clearing Corporation, right? They're going to clear the options, and they'll issue a memo telling you how the options are going to be handled based on the corporate action. So you go here, information memo. I'm on the Options Clearing Corp. It's a little bit slow. These are all the memos, you know, for splits, special dividends. They'll do adjustments. You know, regular dividends, they don't adjust the options. Special dividends, they do. Spin-offs, those types of stuff, they're going to adjust it. So you just type in CP, right? So here it is, Canadian Pacific Limited 5-for-1 stock split. You click on it. You know, here's the memo. So over here, they'll describe to you the corporate action, 5-for-1 stock split. When does it take effect? May 14th. How are the options adjusted? Here's the old strike. Here's the new strike. Okay. So if you have, for example, what do we say? This stock was 400 or something. So here's 400. So if you're holding an option with a strike price of 400, they're going to convert it after the split, and your option, that will be a strike price of 80. Okay. Right. So they divide it by 5. Does that help answer that question? I don't see any other details, but they're going to here. That's where they show you the adjustment to the options. So it shouldn't, put it this, it shouldn't, that corporate action, it's not creating a windfall for anybody, and it's not supposed to you know, harm anybody. The options in the stock, you know, they're all getting split accordingly. If there are no questions, yep, that's
Nope.
good.
Yep.
Okay. I'm going to close this, and let's go to the SPY. So in the SPY right now, we're still near the high. Yesterday, we're near the 52-week high, or maybe even all-time high, right, in SPY. So this sell-off, you know, if we get a sell-off, we're not that far away from the high already. And the idea is that, you know, if it's going to be inflation, if it's inflation fears, it could just create volatility, right? Could create more volatility. Just like when interest rates are higher, the higher they go, creates more volatility in the market, because what happens is the lending rate, right, keeps increasing. And if the lending rate increases, it's harder to borrow money. It creates more volatility in the market, you know, less liquidity, more volatility. Inflation could do the same thing potentially, because if you have prices that are moving around, it's harder to grasp, you know, the stability, and then we could see volatility kicking into the market. Right now, if we look at historical volatility, and this is because SPY as of yesterday was sitting at a high, implied volatility is pretty low, it's subdued, right, in the 11th percentile rank. Let's just take a look at that real quick. So this is an implied volatility chart. This is for the last year. So you could kind of see, you know, we're up here, but it's been coming down. We had a few spikes, but we're still sitting near the low for the year. We could go back, let's see, 3 years. So we had this really big spike, right, for the corona, but it's been steadily kind of decreasing as the market's been going up. Go back 5 years. So we're as low, very low, you know, single digits, 7, 8. Right now, we're at 14. So this is on the 30-day IV, but you could see that we're not anywhere near the high end. I'm going to just put in a 252-day moving average. So this is a historical 252-day moving average. That's where measuring the actual stock volatility of SPY, so the realized volatility, versus the IV30, which is the implied. So we could see here that we're right now below that 252-day moving average. I'm going to compare it also to the 20-day moving average. So we're right probably at the 20-day moving average. The point here is that on a relative basis, implied volatility right now is still pretty low. You know, IV can go up, and realized volatility could go up if these headlines continue, right? If we continue to hear, you know, prices moving up, companies are reporting they have to move prices up. I think that could create pressure on volatility. Let's come back now to the trade ideas card. So we'll keep that in mind, right? Volatility can go up. So there are a couple ways to play it, right? You could get just long options, straddles. You could do time spreads. You could do, you know, ratio spreads. They're different. There's no one way to play it, and it'll really depend on kind of your outlook and when do you think volatility will go up, how far out. We'll just take a look at some examples. So I'm just looking at trade ideas here. So long straddle is one way, right? So long straddle is you're buying a call, buying a put, and you just think that the stock's going to move far away from the strike price, right? So that's one way to play volatility. So stock's at 418. Here's just a long straddle. So this one is saying that on June 17th expiration, buying the 418 call, buying the 418 put will cost $13.74. Theoretically, we're looking at based on historical stock behavior. We think that the straddle is worth $16.28. So that would be the average end value of the straddle if we used historical stock behavior. That's an 18.5% theoretical edge with a probability of success 44%. Okay, so that's from a long straddle, June 17th. Let me take a look at.
And people on the chat looking at this trade isn't available today, right? This was based on yesterday's markets.
So this is based on yesterday's closing, right? So the markets are not open right now, so that we're just using yesterday's closing prices. And if obviously at the open, the stock's going to be at a different level, so this option straddle will be at a different level, and implied volatility could be at a different level. So we're just using it as an example based on yesterday's closing prices. Everything, once the market changes, you know, they'll change because the prices are changing, right? The prices will be different in the morning than from yesterday's close. But we're just looking at it from an example, you know, based on yesterday's close, because that's the prices we have right now. I'm gonna take a look at maybe, let me just expand it a little bit just to see if I find any other, you know, here's another long straddle. So we got a few long straddles popping up in here in different expirations, May 12th, May 14th. Here's a bear call spread. So this would be if you're just looking at a bearish play, you know, bear call spread. This one also a little bit of theoretical edge. So I guess we'll just take a look at the June 4th one. I'm going to come back here, top 3 by edge. So here's the long straddle that popped up. So I'm going to click on this options chain over here. and we'll show you what it looks like, payout diagram. So this will take you to the options chain, and it's going to populate June 14th. All right, so here, I'm sorry, June 7th. So we're on June 7th expiration, buying the 18 call, 688. So here it's populating June 7th, buying the 418 strike call, 688. Then buying the June 18 put, 686. So that's over here. All right. I'm going to load that strategy. And this is what it looks like at expiration. So if the stock remains here, that's at $418. Both those options will expire worthless. So you lose the entire amount you paid for that straddle. So here it is. Right now, the straddle, $13.74, midpoint $13.68. So it's about 6 cents above the midpoint. So you always try to get it near the midpoint as close as possible. The further you go away from the midpoint, the more fee you're paying to execute that trade. But this is here a payout diagram at expiration. So you could see here, if the stock jumps, let's say inflation fears go the other way and stocks run away, then once it covers the cost of the straddle, so from 418, once it's up more than $13.68 away from 418, basically, then it's going to go up 1-for-1 with the stock, right? Because then you have a call that's in the money, the put's already out of the money, but it covered enough to pay for that straddle. So moved enough to the upside to pay for that straddle. After that, it's just going to move 1-for-1 with the stock. Same thing to the downside. If the inflation fears to the downside and people start selling stocks because there's too much uncertainty, once it falls by enough to cover the cost of this straddle, in other words, if from 418 the stock falls by more than $13.68, well, that put will be worth at least $13.68, right? So it covered the cost of both buying the call and the put. And if it continues going down and down, it's going to move 1-for-1 with the stock on the way down. So that's how the straddle looks like from the buy side, right? So you're not necessarily betting on the direction, but you're betting that we're just going to experience a big move, potentially in either direction. Let me know if there are any questions, Will, on that. But that's the straddle. So when we look historically, 1368, how does that compare? So here we're using 4 years of data. I think we're using 6 years before. So if we expand it to 6 years of data, right, historically, the end value is $16.38. In other words, if you did the same strategy over and over, bought the straddle with the same amount of days to expiration, based on the historical percentage moves, on average, it's worth $16.38. Obviously, if I change the data set, let me see, 4 years, average end value $3.13. Go 2 years, $20.33. So it really depends on your data set, and it's up to you to kind of analyze that and look at that data before you make your decision. But what this is saying is that if we just look, the one I have set up, if we looked at last 2 years of data, looked at 19 trading days, same amount of trading days to go, we looked at the percentage moves over those 19 days, and we used similar implied volatility levels like we have today. On average, based on the percentage moves, this straddle would be worth $20.33 at expiration. Today, this is the prices. That would be your theoretical edge. Historically, how many times, if you did it at 1374, how many times would have it ended up being profitable at expiration? That's 46.2% of the time. So we're right up at 930. Maybe we'll look at a time spread, tomorrow, but
excellent. We also had a chameleon mention that there was a big block trade in IWM puts. Maybe we'll show the community how to look at the block trade screener tomorrow. Thanks for doing this, Dima. I'll put a link at the end of this episode in the chat to one more time to register for the webinar. Great job, buddy.
Yep, thank you. And yeah, maybe IWM would be another one to look at, because that one could be even more sensitive, right, to inflation fears, and then expectations interest rates will go up. So we'll take a look at the IWM tomorrow.
Great. All right. I'll see you at 12 on the Interactive Broker webinar series, my friend.
All right. Thanks, everyone, for joining. Stay safe out there. Have a good trading day. Hope to see you guys either later today or tomorrow.
Trade in peace, chameleons. Have a great day.